So, one of the things we want to talk about today is something that's been coming up a lot on client calls and on check-ins. So, one of the things we're looking at right now is how to really maximize your rental property performance. So, overall, we want to look at how can we make sure that we're keeping these properties profitable and we're maximizing the output, but also looking holistically at each investment individually to ultimately determine, is this still a profitable investment? And is this something that is on track with where I want it to be? And if there are pitfalls, can those things be micro adjusted, or can it be something that we might need to look at doing a different strategy around? Maybe this becomes a property that we now would do a 1031 exchange for, or do something where we can rotate it into something that is performing a little bit better. Because as real estate markets change, as things adjust, that's where you need to stay engaged as an investor, not just always sit on the sidelines. There's things that happen in each market that will adjust and change, and we want to be on the position to maximize that. And at SDIRA Wealth, our main partnership and our main goal is to help support you through that. So you know what's happening in these markets that we're in, you know things that are changing, you're aware of anything going on in that area. When we do our quarterly check-ins, we're giving you updates. We're letting you know what's going on the property. So our main focus there is really giving you all those tools, just like you would have a team to support you on as far as real estate goes. We're the one that's going to be helping you guide you and support on that. So what we're going to talk about today is we're going to look at the current rental market trends. We're going to talk about occupancy and rent growth. Are you doing that properly? We're also going to talk about reducing vacancy. It's one of your largest expenses when you have a turnover. How do you reduce that? Property management performance, too. Is the team that you picked initially still on track and still providing the same level of service that they did initially? And if they did fall off, is there a reason why? And lastly, would I need to look at adjusting that management team? So, looking at those, the other piece of it too is property taxes, right? Is there a way, a strategy around that? Looking at also the maintenance, planning for it, knowing what to expect, and then even annually reviewing your insurance premiums, tax benefits, depreciation, things that all factor in. So, most importantly, what we want to figure out is how all these pieces work together to really perform for you, and an annual, at least annually, look at your portfolio to see, but also understanding where you're positioned and how to make the most out of it. So let's start here. Let's start with the performance beyond just the cash flow, because that's something that somebody might look at and maybe I have $5 of positive cash flow at the end of the year, right? Maybe you're in a situation like that. Is that necessarily the worst investment you could ever make? Well, it's going to depend on a few things. When somebody is staying in the property, it's performing well, what are the things that you should actually be measuring, right? So cash flow is very important, but it's only one piece of the equation. We look at cash flow really as the main tool, right? That's the one, that's your operating budget, essentially, right? We're paying the rents, we're paying all the bills, we're doing all these things to operate this rental property, and then we're adding some additional to pay off the mortgage quicker. We're doing some strategy in there. But where we should also be looking at is how much equity growth has actually happened to this property. So if we're looking at, I've held the property for 5 years, how much of that principal has actually gone down, right? How much over 10 years? What does that actually look like? Where is that equity gained? How much have I used my tenant's money to pay off that loan for myself? And then the other factor to look at is the appreciation. So if we're looking at how that property's performed, let's say it's only made you $5, like I just mentioned, a month, every month. Well, if your property value's gone up significantly, let's say you've increased it 50, $60,000 over that same year, well, that's about $10,000 a year in appreciation that you've gained over that time, right? So now we're looking at it differently because this object is now building wealth for us. We're also looking at the tax saving side. Like, have you used a cost segregation study on your property that gave you taxable advantage? Have you used write-offs related to the property? Any expenses that could have happened to help save you more on taxes as well? Because those are the things that are happening also in the background. The property might generate modest cash flow today, But simultaneously, if these things are happening alongside of it, the tax savings, the appreciation, the equity that you're building, we have to make sure you're taking that in as a full picture when you're running the numbers. So one time that I like to talk about is if we're going in and we're looking at we're doing a quarterly strategy call, right? And we're looking at the overall performance of your property, like where it's at today, right? And we are going in and looking at that. So the things that I like to pull and analyze up ahead of that is number one, I like to make sure that I've pulled some recent CMAs. That's stands for comparative market analysis. I want to see where that property has been positioned. And number two, we're going to look at, I'm going to pull our initial pro forma where we're at and look at where our rents are, where our property taxes are at, and where our insurance. So if you have that information, go ahead and pull all that up. We're going to look at all the expenses that are related to that property. And then looking at your mortgage statements. So log in to your account, check where you're currently at, and how much the equity have you built, how much is left in that mortgage. So those are the things that we're going to strategize on that call. But big picture, what we'll cover too is what's happening in the market. So let's dive in there first. Let's talk about the market. One thing we're continuing to see is strong demand for rental housing, right? Interest rates, where they're at currently, have kept more and more people on the sidelines. Incomes have not gone up as drastically as the cost of living. So it's creating this strain that's keeping more and more people on the sidelines to be able to buy their own home, and they're renting for longer. So that's the reality of what we're seeing. So the demand for rental is at a high. And I think this gives an opportunity for you as an investor to really look at that and say, all right, well, what side of the coin do I want to be on? Do I want to be the person renting, or do I want to be the person owning? And then making sure that that's profitable as an investment. So, and some of the most dramatic increases did happen with rents, obviously during COVID and really the heavy spike during inflations. But what we look for in an area is something that's created more of a healthy, strong rent growth. If you look at, and I'll pick on Austin for some friends out there in Texas, Austin was one of the cities that's very boom bust, right? A lot of tech drives that town. During COVID, it became kind of the cultural epicenter of the world. And there was a lot of people drawn into moving there. So we saw significant rent jumps. We saw significant jumps in prices of homes, right? But now it's been a softening ever since. Rents are sliding backwards, home prices are going down. Those are all things that are happening in real time, and where that's why we didn't go into that market. We don't want to look for an area that has that heavy shift back and forth, because remember, for this investment you were in it for a long haul, right? This is a long-term buy and hold strategy. So what we're looking at is how consistent has that market and has those rent increases been year over year. So then ultimately we're deciding where that happens more consistently, and we're going to go into those markets. So I was talking to our CEO, and he calls them boring markets. Boring can be a very good thing, right? It can be stable. It can be something that's going to guard and protect your wealth. And that's what we're looking for. We want stuff like very reliable and very performance driven metrics that we're looking for. That is, there significant job increases happening? Is the city and the county devoting dollars back into infrastructure? Is that area growing and expanding? The other one is, are we looking at the rent growth and the occupation of homes so that they're getting filled? The absorption rate is fine, and all those things are happening. So when you're looking at a market, if you haven't bought a home yet and you're looking at how to maximize this, look for those key indicators. We want to make sure we're looking at the building permits, or jobs getting added there? Is there population growth? Is there a support for rent growth over time, not just today? Because if you go into a market where there's maybe one single large employer and that's the only industry, and it's something like a tech industry or something like a maybe a factory that's driven off of impacts by tariffs and things like that, there could be fluctuations in those markets. So we want that market to be diversified. We want it to have grounding in the economy that we know, okay, well, issues with some of these things happening in the market, I'm still protected because there's this whole other industry that operates. So looking at things like healthcare and education and government jobs and military bases, however you like to break those things down, just things that are very stable, predictable. So let's talk about one of the biggest threats to cash flow right now, which is vacancy. So this is the one thing that I think people don't always plan for well. They know, okay, I have a tenant, they're probably going to move out, but they don't know what to look for whenever that tenant decides to move out and what that's actually going to look like. What's the turnover cost of not only getting that property clean, neat, and back up to par, but also getting a new lease in place, the time I've spent advertising, the time that we have to prepare for it. So the few ways that I think you can really try to focus on doing vacancy properly is number one, if you have it professionally managed, is making sure that you're connecting with that property management team about 60 days out from the lease ending, right? So let's say last July, I got the tenant, they moved in, and now we're in May. And I'm going to give that management team a call and say, hey, management team, here's my situation. I have this lease that's going to be coming up in July on 123 Main Street. Have you reached out to that tenant? Are they looking to renew? And the right answer should be yes, we've done our 60-day check-in. That tenant is looking to renew. We'll send you out a notification. Perfect. Well, along with that, what is our current market rent at? So they should be able to pull that data, pull that information and see where you're at. So let's say you're renting it for $2,000 a month. Is it warranted in this area? Let's say they come back to you and they say that right now market rent's around 2150. If we were going to rent this out, that's probably what we go for. All right. Has that been a good tenant? Yes. They paid on time every single month. Awesome. They want to stay for another year, so that's great. What should it look like for us to renew that lease? Is it worth it to increase it? Maybe we don't go all the way up to 2150 because they've been great, but should it be increased at some point? And you can have those conversations because what you don't want to happen is being so nice that people could take advantage of it. And I've seen this happen a lot too with investors is where, oh, well, I don't want to disrupt this. I'm worried that they might leave. And I decide not to increase rent at all. And you're in a situation where after so many years, you're so far off the mark for where rent should be and where it's your property's at that you start to lose significant cash flow over time and all the other things that have gone up, like as insurance rate premiums go up, as taxes go up, you're still in a situation where now there's this a larger gap to fill. And if you approach that tenant saying, okay, well, my costs have gone up, so I'm going to need to increase rent. Now you look like a bad guy versus because you're trying to increase the rent $400 or $500. Whereas if you kind of can do it gradually and let them know, hey, we're going to stay below market for you. Here's what I'd be at if we listed this, but you guys have been great. I'm just going to do it $50 this time around. That's an easier pill for a lot of people to swallow versus all of a sudden a $200, $300 change to the rent. So I think as an individual owner, you need to make those decisions. But I think it's also thinking about like, am I being a good operator? Am I being a good person? That doesn't mean that if the market's not warranting the rent to increase, that we're still not giving them an advantage. It's the fact that we're looking at how do I keep this tenant happy, but make some slight adjustments. And I think it's more than fair if market rent is $150 higher to only increase it a third of that. So make those decisions and talk to your property management. But those conversations are the ones that you could have those communications with your property manager and avoid a lot of issues. Because what you don't want to happen is July comes around and all of a sudden your property manager calls you and hey, by the way, we listed your property online today, that tenant moved out and you just found out about it, right? Now you're playing catch up. Whereas if that tenant was moving out 60 days ago, prep with your management team. Hey, what's our plan? What's our marketing and advertising going to look like? Is there a way to pre-advertise this property? Do you have the original photos? Can we get this listed early for a January or July 1st move in? You can do some of those little talks and those information with your manager, but you have to have those conversations. So big one there. The other piece is like if your property manager is actually doing like check-ins, right? Are they actually walking by, driving by the property, doing a quarterly inspection? Because the things that you want to look at is the property actually being maintained well. We don't want to get in a situation where they're not keeping up with it. There's maybe infestations or things like that. Like those are things that if we get ahead of it, it's a lot easier to handle early and preventative. We don't want to get in a situation where you're finding out about it later on down the road. So a good check-in, making sure that your property managers are walking those units. And if you talk to all of our property management teams, they do that. But if you're vetting ones on your own, make sure that's part of their strategy. How are they going to check in? Are they going to give you photos? Are they going to give you any insight on that property? So that actually segues pretty well. So property management, what does their actual performance really look like? One of the things that we strive to do is whenever you're onboarded and we've picked out a property for you, is that we actually give you a list of the teams that we've already vetted and the managers that we've already worked with for many years. And we've trusted them to perform well. They've done a fantastic job. We always make sure that our clients get a chance to interview and pick the right team for them. Because everybody's personality, everybody's management style, everybody's rates, fees, everything could be different, management company to management company. So are you working with a team that really aligns with how you like to be communicated to, number one? And also, is their performance metrics on track with what you look for? So the things that you want to be asking your property manager, say, hey, what is your current occupancy rate in this market? What does that actually look like? How many days on market does it typically take to get a new property rented or a renewal done? And then really looking at what lease renewal rates look like, what's the cost of that? So then that way, if I am renewing, I know if there's a small fee to release, or if I have to relist that property for a new tenant, what costs are associated with that? So that way, when you're ready to renew, so I know next July is coming up and that tenant could move out. I'm going to find out in May for sure. But I've already set aside some capital either way, right? I know that I should have this reserve laid out for me. So then ultimately, when I go in and I need to make that decision, whether it's just a quick renewal and I can put some more money and put it into some other things, or I need to make sure that money's there to prep myself for maybe covering a mortgage payment because it's going to take a month to get it reoccupied. I need to know that front side so that you're not scrambling to make those decisions and you're ready for it. So the other thing I like to look at for property managers is really maintenance response time. How long does it typically take to get if a tenant filed an issue, a maintenance request, what's your turnaround time on that? What's your process for that? Do you actually have an in-house team that would handle that? Or is it something that every single time I'm going to have to hire somebody to come out and pay for and do? So ask those questions because those will help prepare you when those things happen. It's not a surprise and you are well prepared for it and you can build it into your analysis. The other thing, and this is kind of just a side note, is like, what does the tenant satisfaction look like? Check those reviews, talk to them about that. Do the tenants really enjoy the way you manage talking to your team? And because that will also help keep good tenants in place when they have a good person that they can turn to, and when there's a maintenance request that's handled quickly, those all will help your case for your property, and people want to stay there longer because they know they're supported. They know they have a team that if they're a day late, they're not going to, on the rent payment, they're not going to yell at them and be angry. They're going to make sure that, all right, perfect, yeah, we'll make this happen for you, and we'll be real people. So I think that investors really should be regularly communicating and getting some information from their property manager. That's one thing that I've seen that doesn't always happen. And when people think about passive income, they don't think about that. So, passive income is passive in the sense that you're not physically doing the work, but you do have to have some phone calls and have some conversations. So, don't forget that part. All right, so how do you get involved? How involved should you be after you purchase the property, right? So that's the question that I think from your perspective of, and we're at this event and actually had one of the speakers talk about this, and it was what is passive income isn't really it's not a real thing, right? There's always going to be some work involved in it. And what you're looking at, though, is how passive can it be and how often should you have it? Because I would say managing a property yourself is completely different than having a property management team running it for you. And that would be a lot more passive than having to go wake up at 4 a.m. and fix something if you were the only person there that could do that, or you're handling every single call, you're talking to the tenants, you're depositing money. Those are all very active things that are going to take more of your time. But if you're going to put on your schedule, hey, well, to operate this property today, I'm going to need to devote 2 hours a month to making sure that the accounting's in order, making sure I've followed up on all the emails, making sure that I've checked in on the account status, everything's rolling, everything's moving, money's where it should be, then in my opinion, that's a lot more passive than me having to manage it myself. And that's why I think paying that property manager is something that's worth it for me. Like I want to buy back my time. And most of our investors are in that same boat. They want to figure out how can I get more of my own time back. That's what the passive side of it is, because you're figuring out how to use your dollars and use your investments to have them start working for you instead of you chasing after the capital. And a lot of people are like, well, why don't you guys do fix and flips, or should I do wholesaling, or should I hop into this deal where I'm gonna go look for tax liens or look for deals online? It's like you can do all of those things, right? You can go out and try to find deals. You can go fix up properties yourself. Like all of these strategies work in real estate. Now, there's higher risk, higher reward for a lot of different things, but at the end of the day, there's someone out there that's making money doing that. That's why you know about it, right? You wouldn't know about it if it didn't work. So if you're learning those things and you want to participate your time into doing that, then absolutely. That's a job in real estate, but it's us teaching you some skills and helping you make money. I share with a lot of clients is that I actually personally started my own woodworking business. This was something that I was passionate about, and I love doing that. But that was a way that when I was in a W-2 job, that was kind of my first step of like, hey, well, if I want to do more investing, I need to start making more income somewhere. So sometimes it's just that, like, how do you find ways to make more money? Like I have clients that will fix and flip at least one or two properties a year, but then they'll take that income and a portion of that income and try to invest it into something passive, right? So they're taking their active money that they've made and they work for, and they're turning it into something that's going to grow without as much of their attention and much of their time. So just like side note on that, for our property management teams, the things that we're looking for to go after is that number one, the property manager should be handling all the leasing, right? It shouldn't have to get involved and figure out who's going to be the right tenant for the property. Teams are good at that. They can find you a vetted tenant for that property. Number two, rent collection. They should be handling all that. You shouldn't have somebody asking if they can Venmo you half of your rent this month. You're not involved on those things. They have a system, they have a rent collection in place. If that team is running the property for you, they have a system for it. They know where to go. You don't have to be involved on that. Maintenance coordination. You should never get a phone call if you have a property management team at 5 a.m. saying your hot water doesn't work. That is something that they are fully incapable and should be entrusted to do. These are all things, again, that we look for in teams, but if you're doing it on your own, plan for that. Make sure they have a good system in place for it. The tenant communication, how does that happen? Where do they go? Again, for us, the tenants don't know that our owners exist. They handle everything with their property manager. I'm sure they know that there's somebody out there that owns this house, but there's a management team that's handling all the day-to-day, all the inspections, everything that you should. But as an owner, you hired that management team, so you are responsible for being in charge of the team that's running the property, but you didn't outsource your ownership. You outsourced the work and the labor related to that property. So make sure that you're not looking at the property management as the end all be all. They are not going to care about the cash flow as much as that on that property as you will, right? They're never going to look at it the same way. It is something in their ownership of as far as like, hey, this is a property that we operate, and they're going to take pride in that. They're going to take care of it if you have a good company, and they're going to want to make it, but nobody's going to care about it as much as you. So making sure that you have a team that's right and that are is in place to do the right things for you. So one of the things you should be looking at quarterly is number one, occupancy rate. So where has your property been fully occupied all year? Or if not, how long was that vacancy? And how does that compare to the regular market, right? So if if you are analyzing that, and hopefully fortunate that you've had your property filled, but breaking down that number. So if you were to take all the cash flow that you've made that year and you looked at you had 1 month of vacancy, what did those numbers actually translate to for you? Did you still have a net gain for that year, or did that 1 month of vacancy set you back and lose a lot of ground for you? So again, it may be fine because let's say you even had 2 months of vacancy and you lost a little bit of money that year. Well, now you have some losses to show on your taxes, number one. But number two, if that new tenant, they stay there for the next 3, 4 years, you've still made up ground. You're still not in a situation where you might have been a little bit of a loss because of the specific situation that happened, but now you're in a situation where it's made up. And I've seen that happen a lot too. So, but it's still something you want to analyze, you want to know about. I already mentioned lease renewal rates, so I won't dive into that a ton, but I think making sure like when your tenants are renewing, are you seeing more and more move outs, right? Like do people move out every single year? And part of that could be the market. If you have a lot of people that are maybe just aging out of properties quicker and it's a higher turnover, but look at those things because higher turnover is always going to create additional costs. So if you're in a market like that is going to be flipping tenants quickly every single month, you're going to have a little bit more maintenance costs than you might in a market that tries to look for a little bit more stability. And one of the transitions I've seen for us is that in a lot of our markets, we are shifting more towards like B plus class properties because that's the current state of right now. Like a lot of people that are building families that are still renting and that might be renting for many years, they want their own home. That's what's pulling them away from apartments and multifamily. They want their own individual space, so it feels like home. But those people with families, they also stay there longer. So if we're targeting things like top school districts, we're looking at proximity to major businesses and employers, as we're building out those developments, you're going to likely see a lot of the same trends happening where you'll have reduced vacancy. So that's again something to look at in your area if you're doing this on your own. The maintenance request, like what does that look like? What's normal? And a big one that I see is making sure that your property management has the warranty information. So if there is a warranty related to your property and the new construction, like what we build, that property manager should always go to the warranty first. But if they don't have it, sometimes they're at the whims of having to just go out and fix it themselves when it could be under warranty. And then you have to go through a whole process of trying to get reimbursed and all this other things. But so just making sure that they understand, hey, this is brand new. Here's my warranty. Perfect. I'm going to go to this first. Then I'll let you know if it's not covered. So next thing, rent growth. As far as is the rent keeping on pace? I talked about this, but really things that you're wanting to document is looking at what the current rate. So if you're doing your check-in with them, just ask that question along, write that down. What is the current market rent for my property? What should it be at? Because when you start to see this gap, that's what you want to really focus on closing in. All right, so next one I want to dive into is property taxes. So something that many investors actually overlook. Now, it could be inevitable, right? It could be in a state where it's a disclosure state where, all right, this property next to me sold for more, so my property taxes are likely to go up because there's been recent assessments made. And maybe they passed a bill to add a new school and they've increased property taxes, whatever that looks like. So we try to help clients stay in the know of what's happening with taxes in their area. But the other thing you want to look at is, are you in a state that allows property tax protest? And this is one that's very interesting. One of the markets we build in Texas is that not only does it allow property tax protest, but it's also a non-disclosure state. So whenever there's a sale down the street or next to you of a property, that's actually not disclosed. And you can verify this if you go to Zillow and you look on the recent home sales, just pick out any property in Texas and look at what it actually sold for. There's just dots there. They don't actually know. Now you can see what it was listed, see if it was listed for rent, but there's not an actual disclosed sale that goes to the state of Texas. Now, the reason why this is important is because you have a lot more leverage when you go to protest taxes because of this, because there's not, they can't go point and say, hey, well, this property right here sold for X, Y, and Z. So I'm going to have some ability now to argue my taxes lower. And what we like to do, especially for our investors, is partner you up with a company that actually does this. So there's a lot of protest companies out there. And main thing that's really nice about it is they operate in a way that you sign up to work with them. If you decide that you want to work with this team, they're going to go out as soon as your property taxes get assessed. They're going to go in and actually initiate the protest for you. They're going to start that. And then the beauty of it is if they win, you pay them just a percentage of what they saved you, so you keep the rest. But the even better part is if they don't win the protest, if nothing happens and tax rate stays the same, you pay them nothing. So they operate in a way where they're incentivized to make money and decrease your taxes, and you benefit from it. So a great incentive structure for that. And if you're not already like protesting your property taxes, if you're a current client, you're and that for somehow got missed, book a call with your portfolio manager. Let's get that set up for you or the customer service rep. But that's one thing that you want to make sure you have that piece in place. Protesting taxes, if you can do that, is going to be a big advantageous method for you to keep that property tax lower. Now, I will say it's not going to work every single year. They're going to want to raise property taxes at some point. It's just one of those things that keeps going up. But if your rent's going up along with it, you should be okay. So one of the things that I like to look at now is people always ask, like, do you do rehabs? Do you do turnkey? Do you do properties that are already existing? And the reality is we do new construction for a specific reason. New construction is one of those things that for us, it's been very predictable. We know what to expect from expenses and we know where to go with it. So if we're looking at a new construction property, we're going to know within the warranty period, within this timeline, everything's new. It's past city code, it's past inspections, we're ready to go. So new systems, new roofs, new HVAC units, and then the builder warranties are all there to protect you. So your major expenses, your major items that people are looking at planning for, you can really buy yourself a lot of time before you have to really expect a lot of expenses for that. And this is something I've seen when people bring other deals, they are planning for up to 20% in maintenance costs on some of these projections or some of these estimates that we're getting. And on an old home, let's say that home was built in 1970, and it's barely had any rehab or any repairs done, then yes, absolutely. You need to plan for heavier expenses. You're going to have to replace roofs. You're going to have to replace HVAC units. All those are getting old. But with new systems, it's going to give you a lot more leeway before you do that and need that. And that's why I think for us, new construction's always been very attractive on that. So we'll kind of dive into the taxes on this now. A lot of investors find additional value in using the tax code to help them buy real estate. One of the reasons why we're here today at this tax event. Now, depreciation allows investors to really offset a portion of that rental income for tax purposes. So we're wanting to make sure that we use that correctly. And depending on your situation, there are strategies that you can use like cost segregation to help you accelerate the depreciation. So if you're getting hit with a lot of income tax, a lot of expenses, there are ways to utilize property and real estate to help you offset those. So if you don't have a strategy or you've never heard of that, I would highly suggest to book a call with our team or talk to your CPA about that because there's a lot of ways that you should be using your rental property to help you minimize taxes. It's one of the great things about the US tax code is there is a lot of provisions in there to help real estate owners and to help businesses. We've talked about that on some of our last workshops, but making sure that you're investing the time to look at that. Because if you're not getting tax benefit at all from your rental property, there's definitely something missing. You should be able to find a way that can help impact you and benefit you. And sometimes it's just easy adjustments to what you're currently doing. Sometimes it does take a little bit more work, a little bit more active participation to qualify, but talk to our team. We will help you kind of figure out what that should look like for somebody in your situation. And then it's like, okay, now I can take this and run to my CPA and say, hey, this is a strategy that I want to do. How do we make this work? And how do we document this? So great for that. The other one I like to mention today is insurance. Some people have been a lifelong insurance person with one company, and that can be a great thing. But what I've found more and more is most of the time, those people are actually paying more for insurance premiums than they realize. And most of the time, those companies are not really giving you any good reason to stay with them long term anymore. A lot of insurance companies really wanted to focus on keeping and engaging and having long-term clients. Don't really see that same loyalty in the industry, at least in the experience of owning rental properties. So what you should be looking at is A, am I well covered? Do I have a good, reliable team? Number one. But number two, is this on track with where we should be? Has this company just increased their premiums every single year because of their name and because of their volume versus because of what I'm actually getting back in it? So talk to an insurance broker, talk to somebody who is in the industry a lot that knows what to look for, because the way your policies can be written too can also impact your premiums significantly. So if you have somebody good, and that's one of the things we like to do is partner you with somebody who's going to look at your property as an investment property and plug in the things that they want to utilize for you and that what you should have as an investor and make sure they shop around and get you the best rate. So utilize those teams and those people along the way. And that's one of the things we're proud of is having that. But it, one thing you want to look at, are you doing that and checking those things annually, or are you just accepting the fact that insurance has gone up? So shop that around. It'll take hardly at all. It can mostly all be done online right now. So take the time to do that because it will, over time, help you save more money. Kind of to wrap, the main things that we're wanting to focus on is, are you actually spending a little bit of time on the work on your property and the numbers? If you're not a numbers person, and you've had properties with our team, that's what a lot of our clients like about it because we can pull all that information together for you. If you aren't a numbers person, just write down the basics. Like grab a sheet of paper. Top line is this is how much I've made in rent this month. Next line, here is my principal and my interest, right? This is my mortgage payment that I'm sending out. Line number two, here is my property taxes. If I broke that down, then we can kind of make sure to see and where we're at. Number three is what you're spending on management. And then the next one would be making sure that you have some money that you're banking and you're setting aside. Typically, we look at around 3% for vacancy, 3% for maintenance. So combine 6% of your rent that you're just, so 6 to 10 that you're just pushing aside. And then you should be left over with that positive cash flow number. If that number isn't positive, go back up and look on those other items, right? Is there anything that we can do to adjust those items? Can I protest my taxes? Can I shop my insurance rate? Is my management team performing well? Are they at the right rate? A lot of clients love the fact that they can come to our team and get a discounted management rate with still really good performance. And we do that because of the volume that we offer. But if you're paying 10, 15% on a property management team, are they worth that? Whereas like our teams can get a lot lower than that, a discounted rate to get that performance. So something to analyze, something to look at. What I would say too is book a call with our team. If you go to SDIRAwealth.com, you can actually book a call directly from there with our team. Or if you're already a client, text your portfolio manager, say, hey, I'd love to do a strategy call and just talk about where we're at on a performance base. Now, those again should be something that you're talking about on your quarterly call. So if you're having your quarterly call with your portfolio manager, bring those things up. We want to help you. We want to make this more profitable. And if there's a little tweak or a little adjustment that we can make, great. Well, if we look at a property and we've gained a ton of appreciation, it might be an opportunity to also look at a 1031 exchange. Can we sell this property to make it more profitable for you? Because at the end of the day, if you're making money and you're happy with your investment, or you want to continue to go down this road, don't get discouraged if it's not, though, because there are other things happening in the background as well that are impacting that property, and it can still be a good investment for you. You just have to look at it from a different lens. It's not always about the exact dollar exchange that's happening like you would see in your 401k, right? Just because you had a month where you didn't make as much because you had an expense, that doesn't make it an overall bad investment, right? There's a ton of opportunities that are still happening and things that are still working for you in the background. So we're excited to help you on this real estate journey. And thank you for being on the workshop today. I will talk to you guys next week. Anything that you need, feel free to give us a call and hopefully reach out to our team. We look forward to talking to you soon. Thanks.